What's going on, everybody? Liam O'Reilly, Vermont Economic Realtor. Hope you're doing well. So, mortgage rates dropped today. Today is Thursday, December 15th. It's the day after the Federal Reserve just raised their rate hikes, or just hiked the Fed funds rate by 50 basis points to, I believe it's between 4.25% and 4.5% on the Fed funds level. They were really hawkish about more rate hikes leading into the future. They upped their their projection for the top Fed funds rate, for the terminal Fed funds rate here in the future. That basically they predict it's going to be at 5.1, where previously they were predicting 4.6 back in September. So really, all news that speak to higher rates headed into the future, and mortgage rates still dropped. So I wanted to talk today about what I think is going on. Actually, first, before I get into that, let's just take a look at where I'm getting this number. So this is the New England Federal Credit Union rate chart. If you look right up at the top here, 30-year fixed rate loan, 5.875%. And they come out with a new chart every day. At least it might be twice a day, once in the morning, once in the afternoon. But I took a look at that this morning because I caught wind that rates had actually gone down, despite the Fed hiking rates yesterday. So I wanted to see what happened with NEFQ, which is, it's really interesting and not something that a lot of people would predict. And it got me thinking about what's going on and why why mortgage rates are dropping in relation, with Fed funds increasing. And it's really interesting. I've been looking at the bond market when I was thinking about what to talk about in this video. I looked at the bond market and saw that the 10-year treasury has also gone down. The 10-year treasury yield has dropped slightly, and it's at around 3.45% yield or so at the time of this recording, which is, still below Fed funds, which is, like I mentioned, at between 4.25% and 4.5%. And in my opinion, that's not what the Federal Reserve wants when they raise rates. The Fed funds rate and the overnight rate, I know they're two slightly different things, but essentially they want that to be the lowest rate out there because there's basically no risk to the Fed funds rate. It's an overnight rate that, it is the 4% or 4.25% to 4.5% is annualized, but it's paid out on an overnight basis. So basically, you give your money to the Federal Reserve. At least this is my understanding of it, and they'll pay you that interest rate overnight, virtually no risk. So taking a lower interest rate from a different party, whether it be the 10-year Treasury, which is still very low risk, but it's not as immediate as that overnight rate that you're getting from the Federal Reserve if you're a bank, which is a big driver of the bond market. So when you see the 10-year Treasury yield drop, and people are willing to buy 10-year Treasuries at a lower rate than Fed funds, it's it's really an interesting sign, and to me it just screams that people are trying to get out of volatile markets as the Federal Reserve is raising rates and jump into these safe and liquid assets like the 10-year Treasury that they know there's going to be demand for in the future and has this guaranteed return when there's so much potential for a recession as the Federal Reserve starts to raise rates and is more hawkish and wants unemployment to rise and wants essentially the U.S. to go into a recession. U.S. Treasuries are at least a guaranteed return if everything else is falling. So I think that's part of the reason why we're seeing the 10-year Treasury fall despite the Federal Reserve raising the Fed funds rate yesterday. But with mortgage rates, I think it goes along the same lines, is that there's still investors who are buying these 30-year fixed rate mortgages, and they want they want a return. Obviously, it's above the Fed funds rate at 5.8%. But if the mortgage rates are too high and affordability is too low, and there's not enough sellers out there willing to transact, then there's not that secondary mortgage market, the people who are buying these loans, these mortgage-backed securities that are all bunched together, and investors can take them as a relatively safe asset because people most of the time pay their mortgage. I think, at a certain level, these investors want that product to be out there. These people want to buy these mortgage-backed securities because they are, again, a relatively safe investment. Um, and if there's not enough mortgages being issued with where home prices are at now, and mortgage rates up at that 7% range, then I could see, it seems reasonable to me that mortgage rates would start to drop slowly until we get more activity in the refinance market and more activity in the home buying market, more sales, so that because there's investors who are willing to buy mortgages at this, at this 5.8% rate. Again, relatively safe investment as we're heading into a volatile time, and what the Federal Reserve wants to be, a time of higher employment, of less jobs, and potentially a recession. So that's kind of my overall understanding of what's happening and why rates are dropping. I'm not really a huge expert in that field, but I hope this gives you a new perspective as to what's going on, and how I see it. If you guys think something different or have some other insight that I'm not seeing, please leave a comment, or reach out to me and let me know. Let me know where I'm missing the mark here, or if you agree with me as well. I would would love to learn together with you guys here. Something else, I'm reading right now Cantion's essay on economic theory, and it's really interesting when he talks about interest rates. He says, I have about 50 pages left to go, but what he is talking about right now is in times of abundance, when money is abundant, interest rates tend to be higher because people and businesses who are making money during this time, consumers can pay higher prices, businesses can charge more, and thus lenders can lend more because there's more of a profit margin for these businesses and for these property owners. So interest rates can be higher when there's more money in the system, and as money gets taken out of the system and becomes more scarce, interest rates need to fall because the margins that these entrepreneurs have start to fall because there's less money. Consumers have less money to spend. Prices, could either come down, or at least the margins get thinner than what they were, and interest rates need to be lower in order for businesses and these entrepreneurs to operate in the economy. And that's been the Fed's main tool to fight a recession in the past, is when rates, or when we enter into a recession, they can drop rates, they can make money cheaper so that there's more margin for these entrepreneurs and these businesses, so that they have more money at hand and they can make more profit if they're not paying such a high interest rate. So, I guess that in that sense, it makes sense as well why mortgage rates and why the treasury, and the bond market is falling, and why those interest rates are falling, because money is being taken out of the system, and so there's less margin to be had with those higher interest rates. So let me know what you guys think. Leave a comment, or feel free to reach out to me. All my contact information is in the description. If you're looking to buy or sell a home here in Vermont or across the country, all my contact information is listed below. I can help you personally if it's here in Vermont. If it's across the country, I will find a great agent who will be able to help you out. Anyway, let me know what you guys think. Liam O'Reilly, Vermont Economic Realtor, and I'll see you guys in the next video.